In our second session, we will discuss whether your next pound going into ESG should be invested with a passive or an active manager. Active funds pursuing ESG strategies can influence portfolio companies in two ways: engagement and exit. Exit is a powerful tool. Portfolio managers can threaten to divest their shares in companies that do not perform to their sustainability standards. Passive managers have fewer tools. They do not have an exit option, and the only way in which they can influence portfolio companies is by engaging with them and voting their shares. Is this enough? It is my pleasure to introduce the panel members: Christopher Iggo, Chief Investment Officer, Core Investments at AXA Investment Management, and Richard Lacaille, Executive Vice President, Global Head of ESG at State Street Global Advisors. Rick will be representing the passive side, and Chris will be representing the active. Over to you, Rick. Welcome.
Thank you very much. And of course, the debate won't be settled today. It'll carry on. But I hope we can make a contribution to the debate. Can I just start out by saying that we think ESG is an important factor in investing for a lot of different reasons. And it could be that there's efficiency at the market inefficiency at the heart of the opportunity. But that doesn't necessarily of index ESG, which has a number of angles to it that Anna outlined. But let me first start off with what we would say in any index context. And on my first slide, the next slide, we asked the question, is active versus index management simply a zero sum or a slightly negative game? I didn't want to start off, particularly in this illustrious company, talking about the subject from a purely academic and theoretical perspective, but I know that indexing has certainly got respectable. But when Nobel laureate William Sharpe talked about the arithmetic of active management, he was really making an empirical observation as well, that after costs, the return on the average dollar will have to be less than the return on the average passively managed dollar. Now, there are a lot of caveats to do with the universe here, and I think we've tested this hypothesis in a sense live for a great many years with fund universes, mutual fund data, and so forth. And I think it has proven to be quite robust, but I didn't come with a whole stream of data, but really to outline again the principal issue, which is why indexing can be effective when not managers can be either under or overweight a factor or a security or a sector if you define the universe effectively enough. And that's true in relation to a customized universe as well, including, for example, ESG-centric companies. But that's really the first line of argument that's not different from ones that you'd have heard before. And in fact, we've applied it in many different contexts, including fixed income, emerging market debt, and many areas where you think there should be a market inefficiency that makes it relatively straightforward for people to outperform. But I think, as we know, ESG has many more angles, and simply performing in line with the index, although it's actually a very effective way of delivering long-term returns, is not the only thing that we can do as asset managers. And I learned this over many years as an index investor, and the last 12 years as global CIO at State Street Global Advisors. You see the good, the bad, and the ugly when you own an index fund, and what you begin to do. ESG, especially G actually, can be very effective in ensuring long-term returns. And that's why stewardship engagement is so important to all managers, but particularly those who don't have the option to change the portfolio. So if you turn to the next slide, just to outline the whole vision for stewardship, the vision is potentially a little bit different for an index fund manager from an active. Certainly the time horizon can be quite different. And the fact that you own all securities tends to mean that you focus on the more systemic issues rather than the idiosyncratic company level strategy issues. And I guess at the heart of that is the need for strong, independent, effective boards to ensure that are held accountable and are effective in their stewardship of the company, including ESG. So that combination of strong, effective, independent boards focusing on a sustainability strategy that we measure in a number of ways, including our own proprietary R factor, but in many other respects as well, gives us a degree of confidence that we're getting good results for our clients in the long term when they're investing in index funds that can include things that may be judged by many to have problems attached to them. But in fact, the very nature of this subject, where you may have a discount for those enterprises that have some challenges ahead of them, means that the catalyst can often be successful engagement to actually realize value. I guess it's another way of saying that the role of the index manager is not just to track the index, but to ensure that they're doing what they can to ensure that the market portfolio has strong returns as a result of attending to these systemic issues. The sorts of things that we do on the following page are driven by the Principles for Responsible Investment and the blueprint that they put together. If you can turn over to the next page, and we'll look at some of the processes within stewardship and engagement. Very important that we need to be risk-based in the way that we prioritize. So look at themes that are very important, but also look at the portfolio you've got and where you can have the most impact in terms of either assets under management or the difference you can make where there's a serious problem. So we have goals for the number of companies that we're engaging with. We don't pretend that we're going to engage with every single company in the portfolio, 9,000 of them or thereabouts, but we focus on the ones that really matter. And we use both our voice and our vote. And I think this has made a difference where we've had a dedicated campaign like the one we had in gender. We put the Fearless Girl on Wall Street. It's been very effective. We set ourselves goals, and I think together with other investors, and we monitor the impact to make sure that we're continuing to hold ourselves accountable for that objective. So that's, I think, an effective combination of efficient portfolios plus engagement and stewardship can give very, very strong effect. I did point out one other attribute of indexing, which is that you can very easily fine-tune the portfolio and the exposures to particular issues that you're focused on. And I think if you do have the viewpoint that the market is not completely efficient in relation to ESG, it's relatively straightforward to design a portfolio that systematically and in the long term extracts those efficiencies by either constraining the universe or reweighting the portfolio in line with beliefs around ESG. So ESG indexing is emerging as not just indexing plus stewardship, but a sort of customization that can focus on where we can make the most impact and have the best returns, particularly for those who've got a strongly held belief around market inefficiency in ESG. So that would be my pitch for why it's relevant and attractive to be indexed in relation to ESG. Thank you. And I'll just finish, if I may, just briefly on my disclosure slide on the last slide. If you can just put that one up, just to make sure that we've all viewed the relevant disclosures, and I'm very happy to send them by email for anyone who'd like them.
Thanks, Rick. Good afternoon, everyone. I think the last time Rick and I were on the same panel, we were talking about interest rates, inflation, and asset allocation, which is perhaps a sign of how things have changed in the investment world. I would pick up on the last point that Rick made regarding ESG indices, and this is where I think the line between traditional passive and traditional active becomes blurred, because any decision to set an investment strategy against an index is an active decision, and I think we shouldn't get too hung up really on the differences between the two approaches. We share many of the same tools, and particularly around stewardship. But I'd just like to make a few points about active investment management in the field of ESG. I work for an active manager, and just to reiterate that the standard argument that the approach of active investment is that it targets a better outcome for the investor than that provided by simply investing in a market index. And those outcomes can be targeted. They could include capital growth, lower volatility, fewer drawdowns, or more income than a passive indexed approach. In order to generate those outcomes, of course, active managers seek to create diversified portfolios through the selection of securities based on fundamental analysis, rather than merely sizing those allocations depending on the weights of the securities in the benchmark. And ESG brings an additional dimension to all of this. It's concerned with both risk management and identifying investment opportunities. A focus on ESG factors allows active managers to identify and quantify potential risks coming from a company's operating model and make judgments about the materiality of those risks. And analysis is fundamental to that process. Analysis would take into account how a business's operations impact on the physical environment under the E pillar, and that could include being at risk from climate change, and we heard some of that in the previous presentation. But we can also incorporate social factors, how the operating model interacts with human capital management, or local communities, or indeed customers. Governance is clearly important, in that a lack of governance can lead to issues around the credibility of accounts, for example, or excessive executive pay, or even illegal activities, as we've seen in some cases in the past. So active managers that are pursuing ESG analysis are trying to identify, quantify, and judge the materiality of these risks that the company may be running, and all of this seen through the dimension of ESG investing. And the bottom line is that it's better to be aware of these risks and to take the necessary portfolio action should they materialize and have a detrimental impact on a company's financial performance. ESG analysis also helps identify investment opportunities. Companies with better ESG profiles are likely to perform better over time. Now, I know that was a question to the previous presentation, and perhaps the empirical evidence doesn't quite support my statement, but I certainly think looking forward, it's a belief that us as active managers need to hold, in that companies that are able to display a better ESG profile are going to be better run companies who are minimizing their risks and exploiting their growth advantages. And that will result in better better financial performance in the future. In very specific areas such as climate change, ESG allows active investors to identify climate leaders, those companies that already have a lower CO2 output, transition leaders, meaning those ones that are leading the pathway to net zero, and the laggards, the ones that aren't quite with the program. And being an active investor allows us to make allocation decisions to those companies within portfolios. So we can allocate more favorably to the leaders and the enablers of technology related to climate change, and exclude, or at least seriously underweight, the laggards. And I think you can make the argument a passive approach would result in a suboptimal allocation across those types of companies. ESG is becoming more central to many investment processes, and the approach requires additional inputs into security analysis, allowing active managers to target non-financial factors as well as financial factors in the investment outcome. And we've heard a lot already about databases of ESG factors. These are one of the tools in the toolkit for active managers today. They allow us to create ESG profiles at the individual security level, and I think the data is becoming better, more informative, and more reliable through time. And this analysis complements the fundamental financial or security behavior analysis in order to enhance the stock selection process. And active managers are thus looking to select securities based not only on their financial fundamentals, such as earnings growth and profitability, but also on their ESG profiles. And the combination in our view, would result in a stronger risk-adjusted return and better ESG profile at the same time for a portfolio that's actively managed. Some of the tools, of course, we share between active and passive managers. I would argue, though, we have a broader set of tools to influence the behavior of companies in terms of their ESG profile. And not least of these is the ability to adjust allocations dynamically through time to optimize both financial and ESG outcomes. Now, I'm not saying that market timing is an effective way of managing portfolio over time, but the ability to reduce or increase exposures to certain companies based on incoming ESG data remains crucial to the success of an active management strategy. We're relying on this growing field of ESG data. Disclosure and transparency is very important. So active managers welcome the development of initiatives like TCFD and SFDR, which is a regulatory attempt to minimize greenwashing in ESG strategies. And I think that supports the credibility of the active management approach because it provides some level of security to the end investor if there is a strong regulatory framework to regulate these strategies. Using ESG data supports active stock selection based on approaches like choosing the best in class, allowing more concentrated portfolios, and managing active risks such as active share in equity portfolios and tracking errors. These techniques clearly lead to a different weightings and risk profiles to a passive portfolio, and that provides end investors with a clear choice between the two different approaches. We've talked about voting and engagement. We share the approach that Rick outlined in terms of adhering to the PRI principles. Voting is an extremely useful tool, as we've seen on a few occasions in the very recent past. And at AXA IM, we are actively pursuing both engagement with company management and targeted voting, particularly on areas around things like climate share, biodiversity, and diversity and inclusion. There is also this focus on active managers having the ultimate tool of disinvestment. I think this needs to be used carefully. We take the approach that we want to engage with companies first, give them the opportunity to convince us that they're changing their business plans. It's very unlikely that individual investors are going to hold a sufficient number of shares or be a large enough creditor that their disinvestment will have a detrimental impact on a company's financial stability. But I think divestment is a powerful and fairly public tool that can be used at the last resort if companies continue to be laggards in terms of meeting their ESG targets. I would also argue, finally, that the broader positive goals can be achieved more efficiently with an active management approach. If we think about the purest ESG strategies, known widely as impact strategies, these are constructed to target improvements in some environmental or social metrics. Strategies often cite particular UN Sustainable Development Goals as a target metric. It could be around clean energy or water or reducing poverty. And I would argue it's only possible to manage portfolios with these broader societal targets through an active approach based on utilising the full toolkit of research, selection, dynamic portfolio management, and engagement with the investee companies. By construction, these portfolios will be more concentrated than a typical passive index approach. Finally, it's clear that clients want ESG strategies. They want to be sure that their managers are taking into account non-financial outcomes. These funds are taking an increasingly large share of investment flows. Pension funds, insurance companies, sovereign wealth, and ordinary citizens want to know that their investments are doing good. They want to be invested in the best companies in order to achieve those non-financial goals. And I would argue that active management is the way that we can deliver on that promise. I'll stop there. Thank you.
Thank you very much, Rick and Chris, for a great start to this session. Actually, you're in agreement on many issues, but let me bring up some possible disagreements. So, a question to Rick first. So, Chris mentioned that active managers hold more concentrated portfolios and they talk to all the companies or most of the companies in their portfolios. You've mentioned that you hold 9,000 companies, of which you engage with only 1,500. So, what's happening with the remaining companies? Is there any engagement with them, or how can we improve, make them greener, the companies that you do not engage with? Could you please comment on that?
Sure. Well, and maybe firstly we should agree the terms of reference a little bit. It being to produce great returns for investors in the long term. That's the objective that we're typically set, particularly for an index fund, which is why they're so widely diversified. If you want active returns and you want a concentrated portfolio, the fundamental law of active management is helpful in sobering you up in the sense of saying you need to have some pretty strongly to have a very high IC to justify a relatively concentrated portfolio, but many do have that, but it's up to them to justify that. Now, part of that could be to do with the SG, and part of the proposition could also be we buy poor companies, we engage with them in order to improve the results. And I think the type of engagement you do if you've got a 20 stock portfolio is clearly very different to the type of engagement if you own everything. It tends to be much more idiosyncratic. It probably tends to be a little bit more intrusive in terms of areas that would normally be the ambit of the board or the management. In contrast, index managers concentrate on systemic issues, diversity, for example, other things that would not necessarily hit the earnings in a particular quarter or year, but across a very widely diversified portfolio would begin to have an impact in the long term. And the reason that we don't necessarily address all the issues in all the portfolios, we may inform portfolio companies of what our expectations are, but their ability to move the dial individually on those issues may not be material in terms of the total portfolio. So like anything else, we're looking at it from a portfolio perspective and thinking, how can we really get the returns that our clients want by focusing on the things that really matter? And really, no matter how many resources we had, frankly, I'm not sure it will be worthwhile to actually engage with every micro cap company on an issue that might not be all that significant. So you always have to think carefully about how you're going to maximize the impact, and that's what index managers do.
Thank you very much, Rick. That was a great answer. So then let me turn to Chris and ask more about engagement. So how can you engage better with companies, maybe with microcap companies you're engaging? What do you do better than passive managers?
Well, I think there are probably a few things that are worth saying. First of all, we state some high level commitments and intentions. So as a manager, we don't invest in tobacco. We don't invest in anything around palm oil or controversial weapons, for example. We have just announced a more restrictive policy to oil and gas, which all of those high level commitments already create a decision of not to invest. Where we are invested still in those sectors and with those companies that we feel need to do more. So if we take climate change, for example, that where they are high emitters and we want to see them on a pathway to being consistent with a net zero future, we can engage with them on whether they have full disclosure of their carbon footprint for a start, whether they are putting in place credible and certified pathways to reduce their carbon footprint, so using SBTI framework as an example, and and that gives us a framework for monitoring their progress towards those goals over time. And clearly, if there isn't sufficient progress, then we would engage with them on those commitments. I don't think this is particularly anything that only active managers do, but what we're trying to focus on is the companies that we think can change their business model the most, improve their ESG profile, and consequently deliver a stronger financial performance in the future.
The next question is about the companies that you screen out, the bad companies. So somebody has to hold them. And is it good for the society that they will end up in the hands of an investor who doesn't care about ESG? Maybe you should not screen them out. Maybe you should actually invest in them and improve them. Chris, do you have a view?
Yeah, I mean, this is a debate we have internally all the time. And there's a very strong argument for staying invested and ramping up the level of engagement. So we know that oil companies probably have a finite horizon to their traditional businesses. But what we want to understand is whether they're going to diversify into renewable energy, for example. And if they are, then we should stay with them. But there will be some companies, and we have some screens, whether it's based on data or a qualitative assessment, where we just don't want to hold. And we think that the way the industry is moving, and the more standardization we'll get in ESG data and approaches, we won't be alone in taking that decision. And more companies will reduce the allocation of capital to. More and more investors will reduce the allocation of capital to those companies. We're already seeing it, I think. There was a Goldman Sachs report last week which looked at the cost of capital for companies in the oil and gas sector, and already the conclusion was that the cost of capital was marginally higher because of the behavior of investors, and that was having some macroeconomic consequences through capacity in those traditional energy sectors. I also think that we shouldn't just think about investors. Consumers will divest as well. And so the business model will come under threat from how a company with a low ESG profile, how its customers treat it.
Thank you very much, Chris. So the next question is for Rick. And the question is the following. So since you hold so many companies in your portfolio, passive managers are less likely to detect greenwashing by companies. What's your view on that?
Yeah, so firstly, I think greenwashing can be a serious problem at every level, whether it's from the issuers or the investors themselves. But the solution to the greenwashing is to view it through the lens of either mis-selling or misrepresentation. And I think we shouldn't, in a sense, put it into a separate category of its own. If you're running a fund management business and you're misleading potential clients about the way that you're managing money, then that's a really big problem. And it's not about ESG, it's just a really big problem to do with integrity and business conduct. And I think regulators need to understand that they have an obligation, they know they have an obligation to ensure there's not mis-selling, of which ESG could be a component. The complicating factor with ESG is that if I'm marketing a credit fund and I say I'm going to have a certain credit quality within the fund or a certain type of asset, and I go off piste, it's quite easy to see. ESG is a little bit more judgmental and qualitative. And if Chris or another active manager says, well, I do take ESG into consideration, and then we find that there's lots of portfolio companies that look like they've got poor ESG scores, it would be quite legitimate for Chris to say, I did take it into account, but there are a lot of overwhelming considerations that meant actually there's a real value proposition in those companies, and what's more, we believe they're going to change their approach and become, in a sense, better. So I think greenwashing is a super tricky subject at the fund level, and I think at the issuer level, because there is no mandatory disclosure of much of the data that we actually want as investors, it will remain a problem for some time. I think there's many initiatives that are going to improve that. I think the ISSB announcement of their takeover of SASB is absolutely fantastic. That won't be a mandatory reporting system, but it will be one that I think many companies ultimately will sign up to, and will eliminate the confusion, should we put it kindly, about the kind of information that corporates disclose, and therefore the greenwashing risk that you identify. So I think we're all at risk of that, frankly, whether we're an index manager or an active. You could say that active had more detective resources at their disposal. I wouldn't disagree with that, but I'm not sure that the investors should be solving a problem that ultimately is a policy question.
Thank you very much. So the next question is to Chris, to give us a little bit more detail as to how you trade off risk, return, and sustainability in constructing your portfolios. Thank you.
Good question. We run a large and varied number of portfolios across different asset classes. But if I turn the clock back 3-5 years, the focus was very much on risk, on using ESG as a risk management tool. So it was, as I said in my presentation, it was about using the evolving data sets to try and identify potentially material risks to a company that could impact on their financial performance, and that's still really the bedrock, I think, of most ESG analysis in most kind of broad-based bond and equity strategies. The investment opportunities, I think, is okay. Here are the risks. How do we solve them, and what technologies, what businesses are going to gain market share by participating in the solution of some of the problems. So a very, come back to climate risk. There are lots of technologies being developed by companies now that will contribute towards the transition to a net zero economy. These provide, tremendous investment opportunities. Now you can have that in the same portfolio as companies that aren't necessarily leading the solution. And you're looking at both the risk side of ESG and the opportunities, or you can develop thematic focused strategies that are trying to exploit the growth potential of those businesses that are providing the solutions. So there are a number of ways to address both the risk and the opportunity question. And on the question of sustainability, the EU hasn't yet agreed on its definition of what a sustainable asset is. We're eagerly waiting for that under the SFDR framework. But from a broader investment point of view, we know what we need to do to try and understand if a business is sustainable. It's one that can manage its ESG risk successfully over time, where those risks don't become a mere material impediment to financial performance, and can grow its earnings or continue to pay its coupons in a way that's sustainable with the transition of the economy.
Thank you. Inma Conde from Mediolanum International Funds has a question for Rick. What are the differences between a passive ESG product versus passive non-ESG product? The way you proxy vote, or the way you replicate an ESG benchmark? Could you please comment?
Yeah, thanks for that question. I think I could think about it in 4 quadrants. An indexing product that does nothing in stewardship, voting, or anything else. I don't think those products actually exist. I think practically all index managers are engaged with that. An index product that does the engagement and proxy voting, I think, is designed to address long-run return issues associated with poor ESG. I think that's the evolving mainstream. People are putting where they can do a more effective job. But I think indexed ESG is going beyond that into the 2 quadrants, if you like, on the right, which is either customized strategies or tilted strategies that in one way or another are capturing this theme. Now, there's a partial link to factor-based investing. Obviously, the classical factors have a great deal of empirical and academic support. The ESG factors, I think we're still, I wouldn't say we're in a theory-free zone. There's certainly been literature, but it's a little bit harder to pin them down as factors in the classical sense of the word, even though there are sort of attributes that you can certainly measure. But I think that's the way that we're going, that we want to own some of these attributes and own them in a way that's systematic. And by systematic, I mean we're not making individual judgments. We are using forward-looking data, but we're not making individual active judgments. Now, you could say that's an active decision. I think Chris has outlined that as well. I think you definitely want to involve stewardship and engagement, but you could do it without if there's sufficient alpha coming from the theme. The great difficulty with all of this is whether the factors or attributes are priced, I think, a window during which there are still many investors who are systematically ignoring some of this information that suggests that there is a following wind from this style of indexing, which is embracing ESG. So for me, that will be the divide.
Very nice. Thank you very much. Now there is a follow-up question again to you, Rick, given from Sangih Burundia from Walber Capital Limited. Given that you invest in about 9,000 companies and engage with 1,500 companies, do you think the increased emphasis and scrutiny on Scope 2 and Scope 3 emissions in the targeted 1,500 companies can help address the ESG risk in the rest of the universe of companies, as such other companies or even a larger universe of companies can get caught up in the supply chain some way or the other? What do you think?
Yeah, it's a really good question because the supply chain does really matter. And we know that with Scope 1 and Scope 2, there is a hugely concentrated, in a sense, a small set of securities and industries generate most of the Scope 1 and 2, whereas the Scope 3 is scattered much more widely. But it's not random. I mean, I think it is possible to begin to work on Scope 3. And it's a submission that we've made to regulators as well, that we'd like to see much better Scope 3 disclosure. If there is better Scope 3 disclosure, the fact that we don't necessarily engage individually with all those companies doesn't mean that we're not able to exercise a degree of influence over the sort of disclosures we want and how we might act on them. Because we choose which of the 9,000 we're going to engage with. And if we think it's going to be impactful, and that within a sector or a sub-industry, they are a laggard in terms of, and it's meaningful in terms of size, then obviously we're going to engage with them. So I guess it's not the case, and I didn't want to give that impression that we look at the largest companies and we engage with them. We engage with the companies where there is likely to be an impact, both in terms of the outcome we're having and also the potential risk or opportunity that we're seeing because of the magnitude of the issue. So I hope that answers the question, but I think the Scope 3 point he's made is absolutely critical. If we can get that right, and the example of Maersk's shipping company responding to its customers and then agreeing only to commission, for example, sustainable ships in future, was a very stark reminder of the impact of supply chains on those who are generating Scope 1 and 2.
Could I just add to that? I fully agree with Rick, and I was at the Investment COP in Glasgow last week, and it was very clear from corporates that were presenting that they are putting pressure on their suppliers. And I think we need to take a kind of network approach to this, that the pressure coming from our focus on Scope 1 and 2 will flow through the supply chain in a very systematic way, and it will address some of those Scope 3 issues, even if they're not being addressed directly.
Thank you very much, Chris. A question to you, Chris, and I think that will be our last question from Yeob Yegen from Hong Kong University of Science and Technology. And the question is how comfortable you are evaluating firms' ESG performance. We know that there is a large disagreement on how ESG raters themselves evaluate this performance. So how comfortable are you in saying that you as an investor do a good job in valuing firms' sustainability. Thank you.
You could have asked me the same question about credit ratings a few years ago. This is an evolving process. The data is getting better. We are getting more transparency. I agree with Rick that as we move towards mandatory disclosure from companies, it will help enormously in giving more credibility to that ESG analysis. But it's not just about data and scoring. It's about qualitative research and engagement with companies, and we have to rely on all those tools to be able to make a judgment in the end, which is an active judgment, and they can be wrong as well as right over the ESG profile of an individual company. But I would say that as this process evolves, we are getting more comfortable in our ability to differentiate between better and worse companies from an ESG point of view.
Well, thank you so very much to both of you for this very insightful discussion. We will reflect on it and come back with better proposals of how to measure ESG and how to make the world a better place. Thank you very much for all your contributions.